Investing in stocks can be as risky as it is rewarding. For beginners and seasoned investors alike, understanding the fundamental aspects of stock analysis is essential. It not only helps in making informed decisions, but also in minimizing risks and maximizing returns. The core of stock analysis lies in financial ratios. These ratios provide a quick snapshot of a company's financial health and performance. They are crucial tools that help investors determine the value of a stock and predict its future performance. Stock analysis doesn't have to be overwhelming. By mastering a few key financial ratios, even novice investors can start making smarter, more informed investment choices. Let's explore these essential tools and learn how to apply them in real-world scenarios. Financial ratios are like the vital signs for a company. They help investors measure a company's financial condition and performance relative to its past or its competitors. These ratios are derived from the financial statements of a company, primarily the balance sheet and income statement. The three main categories of financial ratios include profitability ratios, liquidity ratios, and solvency ratios. Each category serves a different purpose and gives insights into different aspects of the company's financial health. For simplicity, we will focus on three key ratios: PE, debt to equity, and ROI. Understanding these ratios is not just about knowing their formulas. It's about interpreting what they reveal about a company's operational efficiency, financial stability, and growth prospects. Each ratio tells a story that can help investors make better decisions. The price-to-earnings, or PE ratio, is one of the most widely used tools for stock valuation. It indicates how much investors are willing to pay per dollar of earnings. A higher PE might suggest that the stock is overvalued, or perhaps that investors are expecting high growth rates in the future. To calculate the PE ratio, divide the market value per share by the earnings per share, EPS. For example, if a company's stock is trading at $100 and the EPS is $5, the PE ratio would be 20. This means investors are paying $20 for every $1 of earnings. The PE ratio is particularly useful when comparing companies within the same industry. A company with a significantly higher PE than its peers might be overvalued, or it might have better growth prospects. Investors should look deeper into why the ratio is high or low before making investment decisions. The debt-to-equity (DE) ratio is a critical measure of a company's financial leverage. It compares the total liabilities to the shareholders' equity. It indicates how much debt a company is using to finance its assets relative to the value of shareholders' equity. To compute the DE ratio, divide a company's total liabilities by its shareholder equity. For instance, if a company has $200 million in liabilities and $100 million in equity, the DE ratio would be 2.0. This suggests that the company is using twice as much debt as equity to finance its operations. A high DE ratio can indicate a high level of risk. However, this needs to be interpreted in the context of the industry. For example, industries like utilities and telecommunications typically have higher DE ratios due to their heavy reliance on infrastructure, which requires significant capital. Return on investment, or ROI, measures the efficiency of an investment. It calculates how effectively the invested capital is being used to generate profits. Essentially, it provides a snapshot of the potential return relative to the investment's cost. The ROI is calculated by dividing the net profit by the cost of the investment. The result is expressed as a percentage. For example, if an investment costs $1,000 and generates a profit of $100, the ROI would be 10%. This means that for every dollar invested, the investor gains 10 cents. ROI is a versatile and straightforward ratio that can be used for a variety of investments, not just stocks. It is particularly useful for comparing the effectiveness of different investment opportunities, even across different sectors or industries. Consider Apple Inc., a tech giant with a PE ratio often higher than many of its industry peers. For Apple, a high PE ratio reflects the market's high expectations for future growth, driven by innovation and strong brand loyalty. In contrast, consider a company like Ford Motor Company, which may have a lower PE ratio. This lower ratio suggests a more modest growth expectation from the market, possibly due to industry challenges or company-specific issues. These examples illustrate how PE ratios can signal different market expectations. It's essential for investors to compare PE ratios within the same industry for a more accurate analysis. This helps in understanding whether a stock is undervalued or overvalued compared to its historical trend or industry standard. Utility companies often operate with higher DE ratios due to the nature of their business, which requires significant capital expenditures. For example, Duke Energy has a higher DE ratio compared to a technology company like Google. This high ratio does not necessarily mean Duke Energy is in poor financial health. Instead, it reflects the industry's operational norm. Investors should consider industry-specific factors when evaluating DE ratios. Understanding these nuances is crucial in using DE ratios effectively. By comparing companies within the same sector, investors can gain insights into relative financial leverage and risk levels, aiding in more informed decision-making. Amazon, with its vast array of investments across different sectors, provides an interesting example for ROI analysis. Given its diverse range of business operations, calculating its overall ROI can help assess how well the company utilizes its capital to generate earnings. A smaller, more focused company like Netflix, which invests primarily in content creation, might show a different ROI. This reflects its concentrated investment strategy aimed at increasing subscriber base and revenue through original content. These examples show that ROI can vary widely between companies with different business models and investment strategies. Comparing ROI across similar companies can help in evaluating investment efficiencies and potential returns. Understanding and utilizing financial ratios is indispensable for making informed investment decisions. These ratios not only help in assessing the current financial health of a company, but also in forecasting its future performance. By mastering the interpretation of PE, DE, and ROI ratios, investors can better navigate the complexities of the stock market. This knowledge empowers investors to identify potential investment opportunities and avoid possible pitfalls. In conclusion, whether you're a novice investor or an experienced financier, the strategic use of financial ratios can significantly enhance your investing acumen. They are vital tools that provide crucial insights into the financial stability and profitability of companies, guiding smarter, more strategic investment choices.